Welcome back from lunch, everyone. It's great to see you all in the room. And I think the entire program today has been building up to this conversation we're about to have. So I would like to welcome our next speakers, Austan Goolsbee, who's the President and Chief Executive Officer of the Federal Reserve Bank of Chicago, and Peter Orszag, who's the Chief Executive Officer of Lazard. They really need no introduction, but perhaps I might. I am Katie Fallon. I'm the EVP of Corporate Affairs for Fidelity Investments. And we all share in common that we are alumni of the President Obama administration, but we are here today to talk to you in the capacity of our current roles. So I'm going to start with Austan. Austan, if you could take us behind the curtain in your last Federal Open Market Committee meeting, which took place last week, and share what
You're among friends. You're among friends. You're friends.
What happens in a typical, for those of us who are not closely following the Fed, what happens in a typical FOMC meeting? And is there anything about last week's meeting you can share that we didn't read in the headlines?
Okay, there's one part of that I can answer, and there's one part of that that'll send me to jail. The part that would send me to jail is there's a freeze for 5 years, but everything is recorded. So in 5 years' time, you can go back and read word for word every blow by blow what happened. Nobody ever does, and once it's 5 years past, they don't. But in the typical meeting, so I was, if you don't have 28 plus years, I was an economics professor at the business school here at Chicago Booth. And last January, I started at Chicago Fed. If you were a econ nerd like I was growing up, the FOMC meeting is just about the coolest thing in the world, and it's just as good as what you dreamed it would be. Okay, you come in, there's a giant room, there's a huge table, the shades come down so nobody can spy on it, and they go around the room, and here you got the presidents of all the reserve banks, you got the governors, you got the chair and the two vice chairs, and everybody speaks their piece about the economy and give what their opinion. And there is it's got a formalized, even if it's kind of formal, as you would expect. But I say, no offense to the U.S. Senate, this is now the world's greatest deliberative body, I think, the FOMC. And it was, I'm not I'm kind of disparaging them, but I'm not meaning to disparage them. But the dance that comes out of that is very important, very impactful. And there will be a briefing by the board staff from Washington about their forecast and their interpretations of various conditions. And each of the reserve banks, of which there are 12, has its own research department. Chicago, we're known for having a extremely high quality research department. I would say probably us and New York Fed are kind of the two most known research departments. And so everybody will come there with a perspective on the economy that's not just random. And Jay Powell, I knew a little bit, but not very well, and I've come to super respect both his judgment and his ability to take an ornery group of a lot of people and in a very united way keep us on the straight and narrow. This last meeting, it was unusual in that the inflation numbers came out the second. It's a 2-day meeting, and the inflation numbers came out the morning of the second day. So it was a little weird in that sense, but it was an excellent inflation number after a few months of less excellent numbers. So hopefully we'll see more like that. But that's kind of how it's on a cycle every 6 weeks, and it's basically predictable in that way.
So just to hit the inflation question right off the bat here, we did see inflation. We have seen inflation trend down. We do hear a lot about the 2% target. How sustained of a path does that trend line need to be towards 2% for the Fed to take action? And is 2% even attainable?
Yes. Look, it's not only it's attainable, we are going to attain it.
Okay.
We said we will get to 2%, and we're going to get to 2%. How sustained? That's kind of a question of when, and then in a timely manner. I think the thing about inflation is it went way up. The Fed has, by the Federal Reserve Act, a dual mandate. Our job is not always easy to carry out, but it's very easy to understand. Maximize employment and stabilize prices. The law says that's what we do. That is what we do, and that's what we're going to do. We've done well over the last, let's call it three years. We've done very well on the employment side of the mandate and less well on the inflation side. But if you take from the peak to now, on the long arc, inflation is way down. And 2023 was, by dual mandate terms, and really, truly excellent year. There has never been a year in U.S. history where inflation fell that much that did not have a serious recession. So that's a very rare thing to happen. And now the question is kind of, well, how much of that magic extends over into 24? And that we grapple with. I'm not allowed to speak for anybody else on the committee, which is a great relief to them. But I think there is still a little bit of the juice left that's working its way through. And I still can't get past take the long view. Inflation is way down and the unemployment rate is still 4%. And there was when we were in graduate school, 4% was thought to be full employment. Like, you can't have an unemployment rate less than 4%. And we've just been through years where it was less than 4% and inflation's coming down. So that's not a terrible place to be. There's always tribulations, but that's not a bad starting point.
So it seems, Peter, that the markets were somewhat disconnected from this conversation at the beginning of the year. The markets were pricing in, pretty aggressive rate cuts over the course of 2024. And even though Chair Powell himself was predicting early this year in January, that there'd be 3 at most, and since then that forecast has become even more conservative, as we all know. How do you explain the divergence between the market's reaction to the Fed and the Fed's forecasting on rates? And do you see that convergence, dissipating in recent weeks, months?
Yeah, the markets were delusional.
Divergence.
I think it's pretty clear, and they're now much closer. But I want to take a really quick detour before I get into this a little bit more detail, just to say the Marshalls for me were a transformational moment in my life. So I am I'm very excited to be back with you and tell a really, really quick story and then answer your question, which is when I interviewed, it was at the British ambassador's residence. On the way there, I managed to step in some dog poop. So I walked in off my game because I couldn't get it off my shoe. And the whole interview I thought went sideways, including that I had listed that I like to hike. And so one of the interviewers said, "Where do you like to hike?" And I said, "Mount Washington." And they said, "Why do you like to hike at Mount Washington?" And I gave what I considered to be a very well-informed answer. I said, "Well, I've been doing it since I was 10. It's challenging, but you can do it in a day. And best of all, after an arduous hike up, there's a restaurant on top so you can reward yourself." And at the very end of the interview, this very British guy said, "Mr. Orszag, there may well be a place to eat at the top of Mount Washington, but I would not call it a restaurant." That will be all. So I walked out with the dog poop on my shoe, shuttled myself back to Union Station because there were not cell phones at that moment, and on the payphone called my younger brother that actually both of you know, and I was like, I said restaurant, how do you interpret this? He's like, it's more like a cafeteria. So I had flashing before me the end of my life because I had confused cafeteria and restaurant. So any of you who are out there interviewing people, just be a little kind. All right, thank you. All right, look, here's my view on inflation and the markets. They were delusional at the beginning of the year. They're closer to reality now. They were delusional at the beginning of the year because put yourself in Jay Powell's seat. You've got Paul Volcker on one hand, Arthur Burns on the other. It's not even a close call on who you want to be. So you're not going to let this, you're not going to start cutting until you're sure that you've defeated the villain, point one. Point two is, to Austin's point, the economy has held up very well, and I'm going to come back to that. So there was no imminent need to start cutting ahead of time because it wasn't like you were facing just a collapse in the economy and a recession, et cetera. So, and then I also think there's the argument, which may not be as dominant, that it's preferable to go a bit higher for longer so that when you hit the next recession, which will come at some point, you do have more room above the zero lower bound instead of having to go back to quantitative easing as a tool. You put it all together and I said this publicly at the time, the markets were off. So I'm glad that they've kind of aligned. But let's step back to the inflation debate because I'm going to say something a little bit too provocative on purpose, which is I think when you look back at this period with a little bit of distance, it is going to come across that disproportionately, and by disproportionately, I mean like 80, 90%, not 51%. This was the pandemic coming and going. Pandemic came, huge shift from services to goods. Inelastic supply meant that there was huge price increases in goods, exacerbated by supply chain problems associated with the pandemic. Pandemic ends, supply chains normalize, goods inflation comes way down. People shift to, I haven't gone on my family vacation. I haven't gone out to the movies. I haven't, eaten out at restaurants. I'm going to do all those things. And that takes a long time to burn through. And so the provocative thing is, I kind of sort of think that inflation would be kind of close to what it is today, even if the Fed had not tightened. Maybe 10 or 20 basis points, not 150 basis points off, because most of this is pandemic coming and going. And consistent with that, I think most of the disinflation we've seen has occurred despite the fact that consumption has largely held up. It's starting to soften a little bit. Default rates are up a little bit. Lower middle income households are starting to feel a little bit of strain, but inflation's come way down before any of that happened. So this is a lot of supply chain normalization, labor market effects with immigration and productivity growth, and a lot of other things that frankly are not the traditional channels for monetary policy tightening. And maybe you can see it in a couple places, but again, that's why I think mostly you would have seen the same pattern even without the Fed tightening. Now, what do I think is going to happen? I can obviously speak with more freedom than my friend Austan. If I had to bet, I think that we're going, just like we saw last year, there was this panic over whether early in the year inflation started to go sideways and then it kept going down. Robin Brooks at Brookings and I have done a bunch of analysis on that last year period, which we think was affected by lots of seasonal adjustment factors and other things that were causing inflation to go kind of sideways early in the year, and then it declined. I think the same thing is going to happen this year. And that's because there's not a lot of wage pressure. There's a significant amount of productivity growth, so unit labor costs are not off the charts, or unit labor cost growth. There are lots of one-time things that we're still kind of waiting for Godot to play through, from auto insurance to especially housing. I mean, if you take out housing, core inflation's already at the 2% target. So a lot of what's happening is, what the heck is happening in housing when there are known issues in the price, in the way that the price indices work with regard to owner's equivalent rent and other components of housing. So my bet would be that you're going to still see continued downward pressure in inflation. A lot of humility is required here because inflation has been acting, unusually. But that would be my bet. Now, to your question about when will they act, I think even the small probability the market puts on anything this summer is, again, delusional. But the interesting question is going to become September, because if you've got 3, 4, 5 monthly prints that are actually on a downward trend, and you're getting very close to the zip code of where the targets are, if you cut in September, one candidate is going to say that you are being highly political. And if you don't cut in September, the other candidate under that fact pattern is going to say you're highly political. So you're sort of screwed. So since that's my central estimate, I think it's going to be really interesting to ask Austan about the FOMC meeting for a September rate cut when we reconvene next time.
Well, that was very, very helpful. I thought the context for disinflation was coincided, perfectly with Austin's tenure the last 18 months.
Exactly.
I mean, that's true.
When people are like, the Fed screwed this up, it's like, I wasn't there. I mean, I only got there, but it's only been coming down since I've been.
You got to do one of these charts like presidents always do, even if it's not them. Like when Austan comes in, boom.
Yes.
It's
So
down.
going back to Austin, to something you said, that we were able to achieve this without triggering a recession.
Yes.
Why do you think that is? What does that say about the overall health of the?
I mean, part of Peter loves. I was gonna say, he was like, I have something controversial to say. I was like, never change, Peter. But I don't even know that that's that controversial. I mean, the question that became and still remains a little bit of religious war among the economists is the question: did inflation come because of supply problems, contractions to supply, or did it come from too much demand from stimulus, monetary fiscal stimulus and stuff like that? And there's some evidence on both sides. I start from a place that sounds like it's similar to where Peter described, which is, I think a lot of it came from the supply side. And part of that was the obvious supply chain problems. A second part was a massive decrease in labor force participation. That was a supply shock, just like not having computer chips. Like, you did not have people who could come down and work. And the healing of the supply chain is a major component of what happened in 2023. It's why early in 23, just to set the stage, there's some very prominent and smart economists saying it literally is not possible to get inflation down without a recession. And you might have seen, Larry Summers said,
Peter?
the unemployment
That might
rate
not
will
be-
need to go above 6% for 5 consecutive years before you will ever see inflation come down. And inflation came down, like I say, almost as much as it has ever come down in 1 year. And the unemployment rate literally never even got to 4% while it did that. So there was a dispute, and the people on the other side of that tend to be correlated with, they thought it was demand that was the driver of inflation. I think if you go back, you got to explain how inflation soared when the unemployment rate was already above 6%. That is what happened. And that strongly on its face to me says something's going wrong on the supply side. So I think one key part of how it was possible was it was fixing. It took longer than we ever thought it was going to take to fix that supply side, but it is fixing. But the second part that I don't, the premise, the insinuation of Peter's thing was, don't give them any credit. They didn't do anything. It was going to happen.
Awesome.
It was going to happen on its own. And there is some component to that. And if you look at a global, inflation went up everywhere and inflation has come down almost everywhere. But the second thing I want to remind everybody is, we think that the Volcker episode of disinflation was as painful as it was. And if you're old enough to remember, you're like, the interest rate went to 20%. The scarring on mortgages, on everything. One thing that made that episode as difficult as it was is that not just inflation got out of control, but the expectations of future inflation went with it. So when inflation went up to 10%, if you ask people, what do you think the inflation rate will be 5 years from now? They said 10%. And it's really hard to slay the dragon of inflation expectations. This time, inflation went almost to 10%, and expectations stayed absolutely anchored at the target that the Fed set of 2% PCE inflation. And that hinges critically on Fed credibility, I think, central bank credibility. That if you look out the window and inflation is raging, it takes a certain faith to trust the Fed. If the Fed says, no, 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 we are going to get back to 2%, pay no attention to what the inflation rate is right now. That's the Fed making a promise. And if the Fed doesn't have credibility, it doesn't work. The expectations would have gone up, and I think it would have been a problem. And there were people at that time saying, doesn't matter what the cause of inflation is, if it stays this high for too long, you've lost because expectations will unhinge. And they didn't. So I think that's worth something.
Can I make one point on this, which is by the way, Austin just gave the sophisticated argument for why the Fed had to act, which I agree with. But I think this debate over whether it was mostly demand or mostly supply is hugely important. And even though Austin believes that the debate, it's now conventional wisdom, I would say the popular media depiction has not updated to what I believe the reality is. And that matters a lot. And the reason it matters a lot, it comes back, frankly, to the political situation that we're in. When it was framed as your stimulus was too big and the problem was all demand, which was done by some of our former colleagues, the implication is it's Biden's fault. When it's supply side global phenomenon pandemic, that's something that's very hard for any administration to actually control. The framing has stuck, and the fact that inflation's coming down is now, it probably would have been a political issue regardless, but that framing that the elite media frankly picked up on and ran with incorrectly, in my opinion, has had consequences not just to the ongoing way that this is framed, but frankly to the 2024 election in a significant way. So it does suggest, I think marshals tend to believe this anyway, but kind of getting the analytics right and the narrative right that follows from the analytics, really, really important. And the fact that historians may look back and agree with Austin's new version of the conventional wisdom doesn't change the fact that right now it's affecting popular perceptions in a big way.
So if we can pause and just talk about the supply chain for a second here, because we had an interesting conversation this morning about how countries like the U.S. are de-risking and becoming more self-reliant post-COVID, and for us, there's a national security agenda for doing that vis-a-vis China, as we've seen with the administration's restrictions in outbound investments to China and the AI semiconductor and quantum computing space. Does that, so does the confusion about the narrative or that, religious debate about the causes of the inflationary spikes risk, us sort of over-indexing on protectionism going forward, with good intentions? But how worried should we be about exacerbating the supply shocks of the early COVID era?
I'll take a crack at that. I mean, I think they're largely separate, but there are obviously some overlap. So, a great example is in the energy transition and the climate space. And I think the next 12 months are going to be really interesting for a lot of myths that have arisen with regard to climate and the energy transition, including that it is absolutely necessary, but will be really expensive. So the sort of free lunch, this will be easy. Don't worry, we know that fossil fuels are embedded in plastics, aluminum, steel, cement, and pretty much every other input into modern society, but don't worry, this will be super easy. That will be exposed as being a myth. The thought that capital allocation can solve the problem even in the absence of government policy. So, don't worry, the investment management firms can take care of this for you. That will be exposed as a highly flawed approach. And the third piece is there's a lot of tension between the energy transition and two things. One is the local politics around mining. So a lot of what needs to happen in the energy transition involves electrification. It involves critical dependence on lithium and copper and lots of other minerals, and getting those things out of the ground. Hey, look at the debate over Thacker Pass in Nevada, which is the largest lithium mine in the US, or largest lithium deposits. There is tension between the overall objective of protecting the earth and the local environmental consequences of mining. And then the second piece, which comes to your question, is there's also tension between the desire to move fast on lots of things, especially in solar, and the desire to keep the Chinese out of the marketplace. Those are just, this is this has been in the news over the last week. There just is, given the dominant supply components in many of these pieces. Lazard publishes something called the levelized cost of energy studies, and you can argue a bit with the analytics, but fundamentally, you've seen this dramatic decline in renewable energy costs over the past 15 years, much larger than what was predicted and quite dramatic. But you're starting to see the pressure both from higher interest rates, but especially from supply chain constraints in certain areas. And there is that tension, just period.
Austin, anything?
Look, when you join the Fed, it's like joining the Night's Watch or something. Like I'm out of the elections business. I'm out of the fiscal policy business.
Mm-hmm.
And I always say our motto, we got the Midwest motto, there is no bad weather, there is only bad clothing. We come prepared for whatever it is. You tell us the conditions, we get the jacket, and we're ready to roll. And tariffs and deglobalization and every country going to get on their own island. I was a 28 years free market economics professor from the University of Chicago. Nobody in this room is going to out free trade me. And I always said, tariffs are terrible. That like prices go up. I have no opinion. If Congress, in its deliberative wisdom, passes whatever laws they want to, we will adjust. The Fed will deal with that. I think deglobalization can strengthen your resilience, let's call it, or I'm mixing two thoughts. The spreading of the supply chain out of one country can strengthen your resilience, but often comes with higher cost. And tariffs, deglobalization, and putting up walls basically just comes with a cost. That's what I think.
Would the Fed be concerned if there's any risk to the dollar becoming staying the reserve currency?
Well, I remind you, I don't speak for anybody else in the Fed. The dollar policy is not the Fed's to decide. The administration should think that through. And we'll match whatever conditions. We have only two things that we do: maximize employment and stabilize the prices. All of these things affect prices and employment, and so we indirectly have to think about them, but we don't engage in direct dollar diplomacy, if it were.
There's a really good article in the most recent issue of Foreign Affairs on this topic, basically making the argument that yes, of course, the dollar's role is continually under threat. It remains under threat, but the classic argument, like it takes a plan to beat a plan, it takes a currency to beat a currency. And if anything, the thesis of this article is under the surface, if anything, ironically, the US is advancing even further, and you don't see that necessarily in the reserve currency shares, but relative to the alternatives, the distance between the benefits of the dollar and everything else has grown larger, not smaller. So we'll see.
And it's funny, there's a woman who started here at Chicago, Geeta Gopinath, who's now high up at the IMF, who they got data on transactions, business transactions, international trade-wise, and what currency the transactions are done in. And she shows a large fraction of world trade is done in dollars, not in the US. Two countries in other places, they're trading in dollars. And that the share of transactions that use dollars has not been, to Peter's point, has not been falling. If anything, it's been going up over time.
Speaking of foreign affairs articles, Rahul mentioned this morning that you had an article, I think a couple months ago, about the just increasing expectations of business being involved in sort of geopolitical arguments, debates, policy, advocacy.
Yeah.
Can you elaborate more on that?
Yeah. So what's interesting is if you go back 30 or 40 years, the only entities that really had to pay attention to geopolitics were, oil and gas, global oil and gas companies, and a few others. But most businesses could just kind of go about their business and read about geopolitics in the newspaper and kind of shrug their shoulders and say, isn't that interesting? Today, this is partly because, this former Soviet Union was a much smaller share of the global economy than China is. It's partly because technology and globalization have changed the dynamic in many markets. But today, it's, I think, very difficult, if not impossible, to make any important business decision without taking geopolitics into account. So that's fact one, which means businesses are just more exposed to what's happening in the world and need to be nuanced and knowledgeable about them. The second thing, though, is I would say relative, again, to 30 or 40 years ago, companies are not only the objects of foreign policy, they're also the instruments for foreign policy to a much greater degree. So you mentioned semiconductors. Let's take that example. There are lots, but let's take that example. So the US is going about building a ton of new fabs. They're really expensive to make semiconductor chips. They have a long life associated with them, given the capital investment that's necessary. And they are, construction is underway. But whether that policy actually works to increase significantly the domestic production of semiconductor chips, especially at or close to the frontier, the smaller nanometer ones, is going to depend not only on the government subsidies to build these things, but on whether entities like Apple, for example, decide that they're going to they're going to purchase from the US facilities, despite the fact that it is extremely likely that the cost of production will be higher here than, in Taiwan or at other existing facilities. So there's an example of where private business decisions are going to materially affect the outcome of foreign policy objectives. And that's before we get to Gen AI, the biotech revolution, and all the other things that are now foreign policy targets or objectives or what have you. So the relationship's gotten much more nuanced. And the problem is, it's still the case, there's sort of a Mars-Venus thing that goes on. I'm sure you've experienced this, and I certainly have, where people in boardrooms think, why can't those incompetent fools in DC just figure this out? And by the way, I think we can all say, just for those of you who have not had the privilege of serving at high levels of government, the problems are more multifaceted and harder than any other setting that I've been in, at least. And it's easy to kind of say, why don't you do X? When you're in the swirl of it, you realize how complicated it is and that there are no easy problems that reach the White House, period, because they'd be dealt with. Similarly, I think there still is, in parts of Washington, for example, a view that there's just these, all companies do is try to scheme and cheat, and the whole objective is just to somehow connive their way to success. The vast majority of businesses are focused on, what will lead to sustainable growth, and they need to be pointed in the right direction, but they're really powerful vectors for that. So there still is this kind of Mars-Venus thing, and that always mattered a little bit. It matters more when there's this increased codependence. That was sort of
that's been a consistent theme through a lot of our discussions today about the real opportunity we have for public-private partnerships and connections on hugely complicated issues, and that bodes well for the corporate affairs profession in general too. But
one really quick thing though, because I think the debate on this, I'm going to say again something that may not be that popular, but I think is true, which is I think especially we all worked in a Democratic administration, so I'll speak about the Democratic Party. I think there is a view that is now dominant on the left that somehow, maybe I'll put it in the positive. My view is business actually does a lot of good for society. Not always, not everywhere, but in general, business is a force for good in achieving a lot of objectives. I would say that view is not the heart of the Democratic Party today. And that's a shame because you haven't put forward an alternative. Are you talking about nationalizing? Like, what are we talking about? And it's sort of it's sort of fallen under the surface, but there's no affirmative, yes, we actually still believe that this is an important part of a better society. And I think that's a huge hole that needs to be filled.
Well, it's interesting. You see that populist strain, anti-corporate populist strain emerging on the the extreme part of the conservative party now. So there's these very unusual alliances and allegiances forming that will be very, I think, impactful on the next question and topic that I wanted to raise, which I don't think you were here for James's presentation on fiscal policy, and I will steer clear of asking you anything directly about it, Austan. But he paints a pretty shocking future of our trajectory and structural deficits in the United States and our overall debt. I looked it up this morning, Peter, and when you left the White House in 2010, it was 2010, right? But the debt was at 12 trillion, and today it's at 34.6 trillion. And at the time, you spoke publicly a lot about the challenges and sustained issues that the structural deficit was going to pose for the long term for the U.S. economy. So we have a fiscal cliff coming up in 2025, which James talked about this morning, where the TCJA is going to expire. That's $450 billion of individual and household tax cuts that, unless they get extended, will expire. But then also against the backdrop of this debt number and the high cost of debt service, if you put yourself in your old shoes running OMB at the White House, what opportunity space do you see, or how would you advise the president and Congress on seizing the day, which often only happens when there is a fiscal cliff deadline in Washington, to start tackling some of the structural deficit and change that trajectory?
So let me just a couple kind of contextual comments first. So I wasn't here for Jim Peterba's discussion, but I agree with the view that, look, if you look out, and the deficits are projected to be 5 to 9% of GDP, for the next decade. That is very high relative to history. There's a lot of uncertainty. If we have a huge productivity boom, those numbers will come in quite dramatically. But as a central estimate, that is a lot of deficit. So that's point one. Point two is the predictions of fiscal crisis collapse. There have not been many, if any, examples of outright fiscal crises when the debt's denominated in your own currency, as the U.S. debt is. So just a little bit of caution about the kind of catastrophic concerns. But, and now I'll just add a but before I answer your question, but in terms of the overall trajectory and whether you ultimately reach a point where you've got a big problem, a lot really does come down to, go back to your Econ 101 classes, to the interplay between the interest rate and the growth rate. If the interest rate is way below the growth rate, you can finance a high level of debt and even ongoing deficits, for ad infinitum. If the interest rate rises significantly relative to the growth rate, the dynamic can shift really quickly. And so a lot of this comes down to what is the government should have locked in, but did not. And like we had called for this publicly, didn't happen. 3 or 4 years ago, when there was an opportunity, 100-year debt, 75-year debt, lock in those low rates, that didn't happen. So we are now still exposed to the potential for a higher rate environment going forward, which comes back to this question of what will the risk-free rate be going forward? Is it going to return to the pre-COVID levels, or will a combination of energy transition deficits, de-risking, and other factors mean that it's much higher going forward, in which case this debt dynamic is much worse? Now, with regard to the specifics about the debt limit in January, there are lots of times that I am very grateful for being not in Washington, and next January will be one of them.
So, Austan, I'm trying to think of a way to phrase this without getting your disclaimer. On that,
There we go.
On that, Jim also did raise the challenge of the debt service levels. And I think we're, paying interest up to 16% of our annual government spending now in the form of interest on the debt. Does the Fed factor do your colleagues at the Fed factor that into any of the?
I told you I can't speak for them. It's not what we factor in is the maximizing of employment, the stabilizing of prices, and the dual mandate.
Okay.
So if those affect GDP growth, we have to take that into account. But it's not. You can look at the transcripts that have been released. The Fed's independence is rooted in this. If you look at administrations around the world and over time where the sitting government can directly tell the central bank what to do, they have higher inflation and worse GDP performance. And that's why there's near unanimity among economists that you want to have an independent central bank of that form. That's the type of independence. I always said before I was ever at the Fed, the problem of debt and deficits is not that they cause a financial crisis. It's that you have to pay back the money. And so at the end of the day, if you take kids born today, they're going to likely be paying a lot higher share of their lifetime income in taxes than somebody that was born in 1955. And there is a generational imbalance component that's worth our thinking about. But that's about as far as I'm going to say. And that predated me ever being at the Fed. So other than that.
Can I ask you, do you expect the risk-free interest rate to be higher going forward than it was before you arrived at the Fed? Okay,
so in our language, that's called R star. What's the long-run neutral rate of interest? I got our own research people mad at me when I started referring to it as R Sasquatch, because it's unobservable, and you heard that it's there, and what is it? So the thing about R star and long-run interest rates, the thing to remember is that's fundamentally not really chosen by the Fed. The FOMC doesn't pick that. What determines that are long-run supply and demand of capital factors. And over 150 years, the interest rate has come down and down. And for some reasons we understand, and some reasons we don't understand. I think that in the 2000s, there was a particularly low period where literally the interest rate was 0% or even negative in some countries of the world, where some of the drivers were massive savings gluts in other countries of the world that don't have very well developed financial systems. So it's like there's all this money looking for something to invest in, and the investment opportunities are not big enough to account for that, and that's going to tend to pull the numbers down. Not that the dynamics of the savings glut might have changed a little. If you look at every quarter, the members of the FOMC put out the dot plot, which is the summary of economic projections. And one of the questions, they make a projection of what do they think will be the appropriate interest rate at the end of this year, the end of next year, the year after, and then in the long run. If you take that measure in the long run as a loose measure of R star, it's higher than it was right before COVID, but it's lower than the rates are now, i.e. we are being restrictive. And it's, let's call it 2.5% to 3% range. I do think that would have implications for the fiscal budget in a way that you can just go kind of mechanically add up. Hey, if the rate is 3.5%, what does that mean? If it's 2.5%, what does that mean? But that's kind of where my head is.
Do you want to tell us which dot you are? No?
Number 2, they have various numbers.
Okay.
So I do want to open it up to questions before Peter and Austan have to leave. But I just want to have one last question. And is there anything that keeps you up at night? Is there
besides the cicadas?
And is there anything you want to share that particularly energizes you when you wake up in the morning? each morning.
I mean, I always say that the job of the central banker, it's kind of like the night watch, is be to worry, be paranoid about everything and like don't sleep. So like everything would keep us up. That said, the prospects of financial crises originating outside the United States, external shocks have derailed soft landings that were easier to pull off than this one in the past. And so a lot of my stuff is in that space. Or if inflation proves to be more persistent than we think it is, if the supply side healing story turns out to either not be true or not as big as what we hope, then I told you, we made a solemn promise. We're going to get inflation back to 2%. And if it takes more pain to get to 2%, then we have to do that. So I worry about that too.
Anything that you're optimistic about when you wake up in the morning?
Yeah, look, ultimately, the thing that made the U.S. the richest major economy in the world is that the productivity growth has been high and new ideas have proved unbounded. And like Warren Buffett always says, what do you think the Dow was in 1900? And he asked me, I didn't know there was a Dow in 1900, but it was at 50. The Dow was at 50 in 1900. And imagine the list if I came back to the future style to 1899 and I was like, here's what's going to go wrong from now to 2024. Make your prediction. What's the Dow going to be? You would be like world wars and pandemics and Justin Bieber and like every other thing. And you'd be like, maybe the Dow will be 200. You know, how did we get where we are is because the limits, there are the limits of human ingenuity have proved unbounded. And it's going to be fine. We're going to come back in 10 years. You're going to remember, oh yeah, oh man, what a horrible moment. But it's basically, we're going to be on this trend. And I kind of think you can't help but be optimistic if you take the long view.
So I'm going to just focus on the positive. Waking up in the morning, optimistic. Number one is continuing my Wordle streak. I'm optimistic about that. But more broadly, I think it's, just pause. We are living in an absolutely remarkable moment. We're about to go, as someone who's leading the effort in generative AI, from the ChatGPT 4 level, which is basically the way that this person put it, equivalent to a high school education. ChatGPT 5, which already exists, it's just not released, is a PhD level. So within the next 6 or 9 months, I think post, early next year, you're about to see not a 10% improvement or a 20% improvement, but even a massive improvement on top of what is already super impressive. Combine that with advances in robotics, where robots are a lot of our world is designed around hands, things you pick up, things you move, what have you. And the fine motor skills, basically, in the robotics revolution is amazing. And then combine that with the life sciences revolution, and I just think it's an amazing time. Despite all the political polarization, all the problems, and the fact that we're, energy transition is going to be harder than we think, and on and on and on, that's pretty freaking cool.
That's a great note to wrap up on. Any questions in the room? William? Okay.
Yeah, it's coming.
Back from the boundless future to where you guys both began with respect to the paradox of inflation down, unemployment not up. On the one hand, there's been this really interesting paper by Benigno and Ergetson taking a longer view on the Phillips curve and identifying a nonlinear domain of the Phillips curve, which they argue we went through in the post-World War II era, and it's come back. But regardless of that, there's this notion we spend too much time talking about the rate and not about the discontinuous increase in the level of prices. And that what we may be seeing in this sort of conflict between the data and perceptions is that it takes time to adjust to a new level of what will become normal sooner or later with respect to whether it's the price of milk or the price of gas, and that may be the spillover into the political domain.
100% right. If you talk to pollsters, no one understands what the inflation rate is. They understand that the prices are higher than they were years ago.
It's like a time compressed version of like my grandpa's thing around when I was your age, but if going to the movies cost a nickel, I'm not going to pay $10 to go to the movies, and it's like, well, but it was your income faster than inflation? I mean, that's in Fed world, the argument becomes, well, no, you haven't gotten inflation down because the price level isn't back to what it was. And trying to explain to people there is no such thing as deflation except in the Great Depression. That's the only, like, our goal is not, we don't have a price level of pre-COVID target. We have an inflation target, and that's what, it's hard enough to get inflation to the target. And then the second is this thing about the vibes and whether they match the numbers. We always cared about the vibes because the vibes, like consumer confidence measures, were a good indicator of spending. And so they would be a leading indicator, and that began to break down. Not during COVID, that started breaking down in the 2000s. That now, if the pollster calls and asks you, how do you feel about the economy? You say, it sucks. And then if they say, if the guy behind the counter says, how do you think, do you want a 85-inch TV? Yes, I'll take one. There's a lot of people who are saying the economy is bad who are still spending robustly. So our job is to look at the actual numbers on inflation and unemployment. So we still pay attention to the vibes, but we're putting a little less weight on the vibes.
Amr Sufi from Chicago booth. So I agree, like, and it came up a few times. One of the most interesting, probably the most interesting macroeconomic question to me is, what will the 10-year Treasury be at in 5 years? And Austan said a lot. Peter, you asked Austan, but you didn't really give much of your own opinion, and also the factors that you think are going to affect that. I'll just lay my cards on the table, which is I used to think it will come back down to kind of pre-COVID levels because of the saving glut kind of arguments. But I've been kind of shocked at the investment demand potential of data centers, maybe green energy transition, maybe military spending in Europe. So I just wondered if what your view is and what's driving that view, where you think interest rates will be in, say, 5 years.
I think they will be higher than they were pre-COVID, and I think you've delineated the reasons why. The world has been exposed as a much more dangerous place. So military spending in most advanced economies will be higher 5 years from now than they were as a share of GDP 15 years ago. As I already mentioned, the energy transition is not as easy. And so Vaclav Smil, who I think is really insightful on these things, estimates that the energy transition is going to cost something like 10% of GDP annually, for the next couple decades. That's a huge amount of investment and resources. And that's before we get to, what is required around generative AI and et cetera, which obviously interacts with the energy transition because the data centers are incredibly energy intensive, at least given current chip design, and that may evolve. But
in this formulation, there are investment opportunities, so that drives up the interest rate, but not the return on the investments. Like if you just build factories to make guns and they build factories and we shoot each other and blow up each other's guns, in a way, I'm trying to wrap my head around what was the rate of return on.
Well, military spending is always a little funky. Yeah.
Yes. Yes. Yeah. If you raise the growth rate, you're going to raise the long-term interest rate. Our star would be higher. I think that's true.
But Peter, just to push you said
I'm not going to give you a quantitative estimate. What? Yes, I think higher than right now.
Jim?
So So Peter, the long-term fiscal challenge things that I spoke about this morning, I mean, you've been doing this topic for 25 years. You and Peter Diamond were writing about Social Security, and we haven't made much headway on that problem, which is coming up in the early 2030s. At the end of your time at OMB, aside from having maybe not foreseen the COVID pandemic, right, you would have been able to talk about all the things we discussed this morning on the long-term structural imbalances. Do you have any sense on the political economy of these issues? I mean, is it simply hopeless to get these slow burning issues to attract attention in a world where there are lots of other things? Or, given that we do know that during the 1990s we made a fair amount of progress on the structural deficit, is this something where any thoughts on what can go right in terms of helping on these kinds of fronts?
Sure. So a couple of quick comments. First, before I answer the question, since you mentioned that Social Security book, and this came up at lunch, I know you heard from David on declining life expectancy. A key part of that work with Peter Diamond was a very early recognition that life expectancy differentials were exploding in the United States. So people often say, oh, we should raise the normal retirement age, which is neither normal nor the retirement age, because of changes in life expectancy. But what that misses is there's just been a massive increase in the mortality gradient or the life expectancy gap between higher income, better educated people and lower educated, less educated people. That I think maybe even a bit more than what's happening at the average is the first order fact about what's happening to life expectancy in the US that is really important. Then on this question of political feasibility, it's really challenging. It's challenging in a normal environment. It's super challenging in an environment in which you're highly polarized and the parties are roughly equal. So there's no real incentive to move to the middle. If we were highly polarized and one party were dominant, the other party would have an incentive to move to the middle, and there might be some traction. But the reason that we're perpetuating this polarization is there's rough equality, which means you can kind of keep going. So it's that's one perspective. The other perspective is we have just lived through a world in which interest rates were really low. There wasn't any obvious kind of forcing pressure. And if we're right that the interest rate going forward will be higher, and the debt to GDP levels are much higher than they were before, that can change. So people often say it's impossible. I'd say it's challenging. It is important to recognize that things can. Someone once said that in politics things move from being impossible to inevitable without passing through probable. And there is a bit of that with regard to this issue, which is it looks like we can't possibly do something until we do. Now, I don't know whether that's 2025 or 2026 or whatever, but if the interest rate is higher and deficits are in the 5 to 8% of GDP range, at some point, something's going to give. And I think the question becomes, will that almost inevitably have to be disproportionately on the revenue side? Because it's so hard to make progress, especially on the long-term entitlement programs, in any way that is politically feasible without really, really long phase-ins. So that if you've got something that if you want to be altering the trajectory over the next 5 or 10 years, it's just much easier to do it. I'm not saying politically, but just mathematically on the revenue side, if you're going to be phasing in a lot of the things on the expenditure side.
Yes, Jeff Rosenzweig, and for a while I was chairman of the Marshall selection, and we selected Seth Green, who is the dean next door at Harris. But when I listened to Jim and I listened to you, but myself as a teacher and coming from Georgia and going out not just in my university but other places, probably 80% of the people don't know what a deficit is or debt. They would call debt a deficit or vice versa. So here we're talking about the dynamics between deficit and debt and sustainability. We're talking about people not understanding the level of the price level compared to inflation. Do any of you feel, and any of the three of you, are we making progress? Is the median voter gaining some sense of economics, finance, numeracy, or are we kind of sliding down to more innumeracy, less economic opportunity, and what do we do about it if we're not making fast progress? I know Federal Reserves reach out in their districts, for instance. So anyway, anything about that?
I mean, I used to say that the problem, what it felt like to me before I was at the Fed, the problem was that politics became the NFL and policy became the Golf Channel. And by that I meant, I don't know how to golf. I've never been golfing. If you love golf, you can literally watch golf 24 hours a day. And if you're the person who knows there's going to be a fiscal phase out of the tax bill, or there'll be a fight on January 17th, and when will the debt ceiling run? You're watching the Golf Channel. And if you want to purge your life of golf, you're going to change the channel. I never have to see golf ever. And then on the politics side, it's like, bam, they're just going to ram heads together. In that environment, it's not that easy to, you're describing it kind of like a civic education program. It's not that easy to do civic education when the sides can't agree on what is civil. We do within the Fed. I appreciate that you saw last week. I was out at the Farm Bureau in Iowa. They're in our district, and we're talking about inflation. We're talking about food inflation and how agriculture's doing. We got the district is basically Iowa, Wisconsin, Illinois, Indiana, Michigan. And in the same way, whenever some energy thing happens, they call the Dallas Fed. If it has to do with autos, they call the Chicago Fed, because we have the most in autos. We try to do as best we can to explain the dual mandate. The Fed we're not the bad guys. We're guardians of the galaxy. We're trying to, and the good one, not the raccoon one. We're the. And other than that, I don't know how else we do it. You know what I mean? In a way, the fiscal dysfunction in Washington is heavily rooted in dysfunction in our own brains. We, the voters. If you say, whose fault is it? They had back when we were in D.C., the polls showed something like 70% of America agreed with the critique associated with Republicans that government spending is out of control and needs to be cut. And 80-something% of people said they did not consider Medicare or Social Security to be spending. And if anybody said they were going to cut that, they would run them out of town. And it's like, as long as we, the voters, think that, you can see why Washington can't agree. They were basically like, just tell us what you want us to do. And we can't say that.
So what I would say is I am deeply skeptical of two approaches to solving this problem. The first
I thought he was going to say of me.
Well, that too. Of two approaches. One is the sort of all we need to do is go out and teach people that there's a problem, because I think most people get the sense that this is not where it really should be, but there's a fundamental disagreement about how to address it and whether it needs to be addressed immediately. And you're not going to actually convince forcing people to watch the Golf Channel just doesn't work. So that's point one. And the second approach is let's form a commission. And that has been tried so many different times that unless you get to the root of the underlying political will, back to kind of Austan's underlying point, you're, maybe at the margin you help a little, but it's not really, that's not where the action is. Fundamentally, the fundamental problem is the country is deeply polarized and evenly divided, have different views on the right form of government, the right level of taxes, the right level of revenue, the right level of kind of social support. And it's very easy to just delay dealing with this because, no one can credibly claim that there's a friend of ours who used to work with us had this analogy called the M&M problem. So if you're on a diet, you look at an M&M, you can quite rationally say that M&M is whatever it is, 2 calories, and you eat one. Great, that's rational. And then you can look to the next M&M and do the same thing, and so on and so on, and then you've eaten the whole bag. And it's the same thing, which is you can't claim that, oh my goodness, if we don't deal with this over the next 3 weeks, it's the end of the world as we know it, because that's not true. So I think fundamentally it's polarization, different views of government combined with it's not an immediate crisis.
Do you think if we saw, so US demographics are better than almost any other advanced economy, are starting spending levels lower than most advanced economies, starting tax rates lower than, and we don't have a VAT, et cetera. If things began blowing up in other advanced economies, would that motivate us? Is it there is some sense in which we would have canaries in the coal mine?
There was a mini test of that proposition with regard to Greece. I don't think it, maybe if it's France or Germany instead of Greece, but I don't, 5 or 10%, not 90% different. Americans always think we're unique. So that's nice, but it's not relevant.
I see.
Just to leave us with a sign of optimism.
Good.
At Fidelity, we do a lot of financial education across public schools at the high school level. And we're seeing in this younger generation a lot more sort of leading into entrepreneurship, a lot more willingness to experiment with different, savings and investment activities. A lot of influencers on TikTok that are educating young people in this space that are licensed professionals, but also this overwhelming belief that Social Security is not going to be there for them when they grow up, and so they're taking matters into their own hands. So I think that there's
and I would highlight the #1 rated free museum on TripAdvisor is the Money Museum at the Chicago Fed. So if you're down in Southwest, show up.
Now you need a Taylor Swift song.
well, thank you.
Thank you, guys.